Going live. All right, welcome to the Tech and Venture Brown Bag. We're here at the Stamford Innovation Center. And we're here with Adam Quinton. Adam is filling in for Skyler Fernandes, who usually does these with us. So a few, maybe, hopefully 10 times a year, we get around to doing these.
Yeah.
And the way it works, Adam, is I've got a few questions for you. If you have some topics that spring up
Right.
as we're talking,
Okay.
feel free to just, talk about whatever comes to mind.
And I've got to impersonate Skyler. That's
No,
the
you
good
just
thing.
you just be yourself. You got the greatest accent, so your accent is like 10 times better than his. So you've already got that going. So we'll just talk about whatever, and then we've got an audience here who I think have some questions for you,
Uh-huh.
and we'll go as long as we go till for about an hour.
Okay.
So the first question is an easy one. Talk about your fund and maybe your background a little bit and the sort of investments that you make, just to give the audience a bit of information about you.
Okay. So I'm a very early stage, sort of seed stage, angel investor. I've got my own vehicle called Quinton Ventures, which is just me. So decision making is very easy because it's just me. Although sometimes I get confused, which makes the decision making hard. But anyway, I've invested in 10 companies. They're a little bit sort of all over the place. Generally have a clustered in a sort of B2B enterprise world. To some extent, I've got a little bit of a sort of a Warren Buffett. I've got to understand it before I invest in it perspective. Although I probably stray away from that a little bit, but in general terms, I try and go for things that I can understand. And that, again, given my personal background, I used to work in a large company for a long time. So I sort of understand how big companies work in very general terms, and that can take me in all sorts of directions. But again, I've got 10 investments at the moment. I've been making 3 or so a year. And none of them have gone bust yet, which is good.
That's good. And they tend to be all female owned or female founders?
Well, one of my sort of filters, if you want to call it that, is that you're investing in entities which are, by definition, doing something new. They've got to be creative. They've got to climb over walls. And, in that context, having both founders, early stage management team, whatever you want to call it, that is diverse, I think is incredibly important. I'm a big believer, and it's not just a belief, it's based on, I think, a lot of good evidence, in the power of diverse teams to produce better results. So, you can apply that in all sorts of different contexts. So there's evidence, for example, that large public companies with diverse corporate boards, including gender, but also other dimensions, basically those companies tend to perform better than companies with homogeneous leadership teams. But that applies like all the way down, because it's not about boards per se, it's just about decision making in groups and being creative and identifying things that the homogeneous group wouldn't identify.
Right.
And again, I think that applies, well, at least I personally think that applies across the board down to the startup level. So,
So if you look at the universe of funded startups, and you look at what percent of them are run by women, it's not a great percentage. And if you assume that the other people that are not run by startups are probably missing something that these women startups know about, chances are you're going to find some interesting stuff.
Well, there's another sort of Warren Buffett thinking element to the thing, which is, as any successful investor like Buffett, of which there's not many actually, will tell you, you don't invest where everybody is. Right? You've got to be contrarian and invest in the things that for some people are, not so obvious, more challenging, and that's typically where the best investment opportunities lie. And again, I think in the context of the early stage world, that type of thinking, particularly if you're thinking about diversity of leadership teams, takes you into a particular direction, which is saying, look, hey, this is really weird, actually. Here's a statistic of companies in the last 3 years funded by VCs, all companies in the US with VC funding, what percentage had women CEOs? Anybody guess? Sorry?
6%?
3.
3%.
3.
Oh, number
So
of companies?
97% of companies that got VC funding in the last 3 years had male CEOs, 3% had women. Something like 85% of companies, again, this is venture funding, so it's not early stage angel,
right.
which is a little bit different and,
right.
and better. But I think of companies getting VC funding, something like 15% have a female founder. One female founder, at least. Sorry, 15, yeah. So whether it's the 15% or even more so the 3%,
right.
you know, unless you think that you know, that particular part, in fact, to be roughly exact, that half of the population, you know, isn't as smart, doesn't work as hard, right. isn't as creative,
yeah.
you know, can't run a business,
right.
unless you really think that, then you look at those numbers and you think, well, there's some sort of essentially dysfunction in the funding environment, which means that there's a big chunk of the startup universe that for some reason, and we can talk about what that is not getting, you know, certainly not getting its sort of proportionate share of the investment dollar, but it's certainly not getting its proportionate share of attention.
Right.
And you know, my contention would be, again, with the Warren Buffett investor hat on, well, that points you in the direction of why is that? And if people aren't looking at that group of companies and they're ruling them out for some reason, maybe they're the ones that you should actually think about ruling in.
Right.
Sorry, can we take questions? Can we do that?
Sure, go ahead.
Based on that, I'm flipping the way you look at it, saying, I'm a founder, I have a 500% more chance, 500% greater chance if I just bring on yes, 500% greater chance to get funded.
Well, guys, we have to repeat the questions. This is why we don't do this too much. There has to be a short.
Okay.
So the statement was, is it really a 500% better chance of being funded if you're a female founder and you find a male co-founder, right? I believe that was your point.
I guess the numbers are what they are. You know, whether if you did that it would work is sort of open to question, because if you are, you know, if you are truly the founder, as in it's your idea, you know, it's your domain expertise, it's your passion that's driving the thing, then, you know, if you just bring in, you know, the human being that like you think looks right for the audience you're, you know, selling into, because ultimately you're selling the equity of the company, that's what you're selling when you're talking to investors. You know, you're probably getting into some sort of double think situation where the investors are going to say, well, there's something really weird here. Like the person whose idea this really isn't actually running the thing.
Right.
Like that's not going to work.
Right.
So you probably, if you're not careful, generate like an immediate investor red flag. And it probably wouldn't work, would be my guess. And, you know, you might improve your chances, but whatever.
So you know, we'll get to some questions in a little bit. You know, you and I are involved with an accelerator here in Connecticut called the Foundry, which is really interesting in trying to teach people the skills of how to become a startup. Right. Which you know it's very much in line with the goals here at the Stamford Innovation Center, where we have classes, we have co-working, we have a real environment helping to help people grow those skills bit by bit, and that's really what we focus on all the time, whether it's men or women. Obviously, we obviously don't care. My contention is that the you know, just like Connecticut is not known for a ton of startups, and I'm just trying to make a generalization. We're not known for that, but as we do it, we're going to get better at it. We'll get better known for it. Obviously, there's been more and more successful females owned startups over time, because they're going to have more mentorship, because they're going to have more experience, because they're going to have more failure, because they're going to have all those experiences, right. and so it's, you know, it's probably more a statement of historical fact than it is anything, you know, that has to do with genetic makeup or right. ability to run a company. Would you agree with that?
So your point is essentially that
we have history to combat, but it doesn't mean there's anything that's holding us back.
I think that's true. Yeah, I think that's true. I would, at the risk of being a little bit pessimistic,
Yeah.
I would say one thing which is not going to change very quickly. So you say to yourself, like, why are only 3% of VC-backed companies? Why do only 3% have female CEOs?
Right.
And then you say to yourself, well, actually, there's a sort of inverse statistic related to that, or actually not inverse statistic related to that, which is probably somewhat connected, which is this. So here's another quiz question for the audience. What percentage of partners at VC funds in the US are guys? And the answer is,
95.
anybody shout out the answer? What percentage of partner level people at VC funds in the US, all VC funds, what percent are men?
80.
94.
94.
94. And if you look at the Forbes Midas list, which is a bit of an unscientific list of the top 100 investors, so it's not, they're all partners, but it's the partners that are deemed to be, like the most influential, write the biggest checks, blah, 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 blah. If you look at that in, from year to year, the number of women on that is like 2, 3, 4. I think last year it was 4. So again, I think the 3%, 15% numbers on the one hand and the 96% are somewhat connected. And what's underlying it is what they call, there's two things that come into play. One is unconscious bias. My perception of what a leader is based on a whole sort of lifetime of experiences and beliefs. And 96% of the people, or whatever it's 94% of the people in one particular category are going to have somewhat similar set of beliefs. And if there isn't enough weight from the other side balancing that out, they're all going to tend that something that looks familiar to them, which is the pattern recognition, that is what a leader, a successful founder is.
Right.
That doesn't mean that like Silicon Valley only backs, guys from Stamford and hoodies, but it does back a lot of guys from Stamford and hoodies. And some of them are very successful, but like they miss a lot of them.
Closer. I'm sorry.
Yeah, it's like
I can't. I'm sorry. That's what we got.
we can speak up. We'll be
We
good.
are where we are.
It's really hard to listen to what you're saying. Even there.
That's the environment we're in. So.
Yeah. We got to disrupt that.
Yeah.
Like do something different.
Yeah, go ahead.
So I'm doing a startup with a couple of my friends and colleagues or old colleagues. But when you bring a venture capital or angel, or I guess venture capital, when you look at it, do they actually care about what background you have? Does it really, how much percentage does it play a role when you're investing to a certain business?
Okay, so the question was what weight do
How much weight or what, do you actually care about what background?
Yeah. So the question was what weight do investors put on the background of the individual? I couldn't give you a percentage number. The answer is, it's definitely important. It's definitely important. It's going to depend a lot on the investor, quite what you're doing. So it's hard to answer.
Well,
But
certainly, like if you had experience with a startup, that would be a significant, improvement. But
But for instance, let's say we don't have CFO, but it's something that we could definitely get CFO on our seat. But my wife is qualified, more than qualified.
Right.
But the question is, do you care if we have CFO or not? Do you care if we have marketing person with you or not? That means breaking out equity, right? So hiring them as our business, we're actually hiring them as our partners. So you should be able to consider having all that people in our seat ready for you to review versus, hey, we don't have someone, what should we do?
So the question there was a little bit about the team and how much the team matters, right? Again, it's going to depend on what you're doing, what stage you're at. So like having a team that looks right relative to the stage is like the unhelpful answer. You specifically mentioned the CFO. I think at a relatively early stage, which could even include up to like the Series A stage, I think a lot of investors would actually, this is just a personal view, but I think a lot of investors would actually be worried if you had a CFO. defined as a CFO is a team member who's got equity and paid to be the CFO.
Yeah.
Because most investors would say that is a waste of time. Because basically, you can, if you're like a 5-person business or even a 10-person hire business, basically, combination of QuickBooks, and then if you have to have it an outsourced, $100 a week accountant, that's your CFO. So you can, and there's a plethora of outsourced CFO organizations who will deliver like basic bookkeeping services to controller services to VP of finance, or even more sort of thought-intensive CFO stuff. So you can outsource that. So actually having that in-house could actually be a bit of a red flag, because what it could tell the investor is basically you're wasting money on stuff that for your early stage isn't that important yet. So you've got to be careful, I think.
So actually, along those lines, I put together sort of a bullet list of elements of a team or a founder with a CEO, or with a startup idea that might come to you. And I don't know, I don't want to rank them, or maybe we just talk about them, and then maybe you can sort of put them in a high, medium, and low category. So the first one is passion for the subject.
Right. Well, you said something I just wanted to jump in on. So you talked about the founder or the team.
Right.
If you're a sort of statistically sensitive investor, you'll know that you've got to be much more careful investing in a team with a single founder as opposed to one with multiple founders. Basically, the failure rate for single founder teams is significantly higher than the failure rate for multiple founder teams. For sort of an obvious reason that, doing startups is really bloody hard work. And unless you've got somebody, to scream at or to say, what the hell do we do now? You're going to end up making bad decisions. You're going to end up losing your mind potentially. I mean, I'm saying that in a flip way, but it's sort of semi-serious. So, the characteristics that you look for in the key individuals.
Having a team.
Yes, but having a team.
Having a team is a pretty big checkbox on its own.
So that could be 2 or 3. I mean, obviously, if you've got 7 founders, that's going to be dysfunctional as well, because you're not going to agree on anything.
Right.
So, like having a couple, 2 or 3 founders, it's not just something that like feels good. It's actually statistically correlated with, basically more successful companies. So, from an investor, you look at that, and then you're going to go through your punch list.
Yeah, punch list. So, well, maybe in a different order. Well, let's say passion. So, passion for the subject or the problem set.
Without having them in my head in any rank order, I mean, that's definitely pretty high up. If only because, the startup founder is either going to get paid very little or nothing at all.
Right.
So they've got to have a dream that they're dreaming that they really want to follow through with. They're going to have a lot of problems, face a lot of challenges. So they've got to have passion to help them, like over the wall, whatever they have to do. And I think without that, you can also, and this is talking at it from the investor's point of view, and I've seen this happen actually, you can get yourself in a situation where, you're backing something which looks good at that point in time, but where because the founder doesn't really have the passion, like a year or 2 down the line, they give up. And there's one company I'm thinking of, which I won't name, where, the founder, they actually went through, I'm not going to name it either, but they went through one of the big name accelerator programs.
Sure.
And they were told in the accelerator program, well, like do this, do that. And essentially what they were doing was not sort of fulfilling a dream, but basically sort of doing what they were told, doing the cookbook. And like at 2 years into it, it was getting really hard. And they'd raised money, they had decent scale. But it
just didn't give a crap.
It wasn't, they probably gave quite a lot of crap, but they didn't care enough.
Right.
So, passion is sort of fundamental.
Yeah.
I think,
so there's one that's come up in the foundry work, which is mastery of facts. So mastery of facts in terms of data around your industry. But the one that came up that was really interesting for me, because I'm not a great numbers person, is understanding what you're negotiating on, at different rounds, and what am I giving up? And being able to be fluent in industry facts and sort of startup industry, financial
Right.
facts.
Right. I think that that's an interesting one, the startup industry fact one. And it plays into something which I think from a sort of entrepreneur's point of view is sort of obvious if you think about it, but a lot of people don't, which is that if you're talking to an investor, could be an angel investor, VC, whoever, essentially every interaction you have with them is not explicitly, but is part of the due diligence process they're going through with you, right? So due diligence could officially be like, give me your cap table, give me your model, give me your like sales pipeline. There can be things that are technically called due diligence materials that the investor would ask for. But going through that process, the investor is also going to be, again, doing sort of implicit due diligence, which is simple things like, okay, so when I ask for the cap table, do they give it to me, or do they say, oh shit, I've got to work one up, I'll get back to you in a week? Like that's red flag. If they say, here it is.
Oh, so my
right. I'll email it to you now. Here it is. Or even better, I've got a bunch of materials in a Dropbox. I'll commission you for Dropbox. It's all in there. Like that is part of the due diligence process because the investor's thinking, I'm looking at you through this tiny little window, right? I only see a little bit of you. And if what I see is like disorganized, you haven't even got basic stuff like that together, like how can you run a damn business, right? If you can't even get simple materials like that together. So, being organized is important. And another piece of that, just to sort of extend the thought, would be, okay, so you're well organized, you've got your stuff together, documents, all your stuff, and that's great. So I'm thinking this is a really organized person. Maybe they can run a business, maybe they can make some money, that's good. So that's like a sort of an obvious level. But then you get into, which I think was where you were headed, Peter, like we're now talking about terms, right? We've got a bit friendly and you're saying to me, like, I'm thinking about giving you a term sheet, pre-money, this, and this. That's another sort of implicit due diligence thing, because if you offer that to me, if I'm the entrepreneur, and I, as the entrepreneur, just say, oh, thank you very much. If you're the investor, you should be thinking, well, hang on a minute. Like,
that was too generous.
Well, but besides the fact that I was too generous, you should also be thinking, well, what does it tell me about this person's, like, again, broader business acumen, if you want to call it that? Because, like, there must be something in those terms they don't like, or there must be something that they want to negotiate. And if they can't negotiate with me over something as fundamental as this, particularly if you're talking, well, like anybody in any business has got to negotiate with somebody, right? You've got to negotiate with a landlord when you take out space. You've got to negotiate with a customer if you're doing some, whatever. So if you can't negotiate and don't understand this fundamental contract, which is giving up a piece of your life, right? The company is your life. You're giving up a chunk of your life, and you can't understand the terms, and you can't negotiate those terms. But the next day you walk out of there to do the the deal that you've got to do with Comcast. I'm going to think they're just going to walk and get the worst terms they can because they can't damn negotiate. Like this is like if they can't negotiate this, because I can't walk out and sit in with them when they're negotiating the rent with their landlord. But this is where I can see them through the little window.
Interesting.
If that makes sense.
Yeah. And I guess mastery of facts around their particular subject.
That's sort of like an obvious.
How about ability to collaborate, both with investors, partners, and team?
I think that's a more complicated one. In the sense that depending on who you're talking to, a lot of investors will say, we like to invest in entrepreneurs who are coachable. They've got to be coachable, whatever the hell that means. And on the one hand, somebody who can, take advice and respond to it, that seems like a good thing. But at the risk of using male examples, do you ever think Mark Zuckerberg is coachable? The really sort of passionate, determined people, have this sort of like vision, which again, they're going to keep going through the wall, over the mountain, whatever.
Right.
So I sort of go both ways in that one. Like if somebody is like too collaborative in a way at the stage that you're talking about, which is the early stage, doing really hard stuff, you know, maybe they're not going to be able to go over the mountain, through the wall, whatever.
Right, they're making too much to a partner.
Yeah.
Right.
So it always worries me when investors say we like people who are coachable. So what do you mean? You want people who like want to do what you tell them to do?
Yeah.
Because basically, you know, with a very few exceptions, most investors, you know, they shouldn't be relied upon to give you advice. I would say in all candor, because like, you know, as a founder, you've got your own vision of what you're doing. You understand the market better than anyone, or you should do. So why should you take advice from me who like drops in and drops out?
Yeah.
So anyway, I'm a little bit whatever on the coachable thing.
Okay.
Well, I'll ask you a question. So, as a CEO,
Yeah.
there's no way for me to know, because let's say my background is IT, there's no way for me to know marketing strategies. There's no way for me to know, or there's no way for me to know everything that is out there. However, if you're my venture capital, it's something that I could expect, say, hey, wow, what do you think about this way? Or you know someone, or any legal, let's say,
Right.
I'm writing the legal, one of the obstacles legal, right?
Right.
Hey, I need to have a legal agreement of some sort. You know it, because there's no way for me to know what those terms are and things like that. So from that cultural perspective, is this something that venture capital can help us?
I would sort of challenge your initial statement in a way that you probably wouldn't like, which is to say, if you're the CEO, it's your job to know everything.
Okay.
You're expected to know everything. That may be unfair, but you sort of are.
Sure.
To the extent that, like the definition, you know, nobody knows everything. Like it's an unfair ask. But on the other hand, you know, it goes back to the team point. If you've got people around you who like filling where you are weak, then you know the investor's going to logically, if they are logical, going to be looking at the whole team. But crucially, you've got to have at least a handle on everything.
Well, when it comes to the legal aspect, right? Not many people are familiar with legal terms and agreement that you see online.
Right.
You have to find a law firm that can take care of your needs.
So that you give out equity or pay them whatever it is.
You pay. I mean, some of them will take equity.
Yeah.
Some of them will do early work for cheap with a hope to get more business later when you do have money. It varies, but you can't ask your VC to be your law firm because you're actually negotiating with them.
It's a question to ask you that you don't.
Oh yeah, you can ask them.
Well, I think again, rightly or wrongly, one of the reasons you're sort of expected to know everything is Google, right? No, seriously. So, you know, if there's a legal term that you don't understand, you can Google it. It's there in 10 seconds.
There's a question on that. I mean,
But
the way you write it, so that you are covering your beer.
But it depends what you're talking about. But where I was going that was, you know, through the wonders of Google, even if you didn't have any advice, you know, what you can find very quickly is that there's a lot of big name law firms who have, like Oric or Wilson Sonsini, some of those folks. I mean, they have chunks of their website devoted to startup information. I think there's several of them have got like build your own term sheet things, right? Where you just say, you know, you can just sort of, it'll take you through the things that you have to put in, what you've got to decide, explain what the decisions are. And that's like that's like their open source. So again, there's a lot of stuff legally that you can find. And then, you know, your lawyer will usually do you at least until the first round of funding on a deferred payment basis.
Let's keep going through these and we'll get to some more questions in a little bit. Next one, written communication skills. I mean, all these are important, so it's sort of fun just asking you how you feel about them.
Well, to my point, it's like a bundle of everything. And this one sort of probably falls into that category of it isn't sort of obvious, but it's part of that sort of implicit due diligence process, right?
Experienced business person.
Like, you know, if you know, I email you something, you come back with some sort of flip, badly spelled answer.
Right. With no caps.
Does that actually mean that you can't be the next whatever? Who knows? But I'm probably going to think a little bit less highly of that entrepreneur in a way that's it's probably not really proportionate to the sin of not spelling the word right. But again, I've got this tiny little window, and that's my little window, and it's like, you know, they can't do this, they can't do that, they can't spell, you know, whatever. And you know, one thing that is important to remember in that context is that, you know, most investors that you meet in any sort of formal context or whatever, their main objective, they, you know, people just express it different ways, but their main objective is to say no. It's not to say yes, it is to say no. For one simple reason, which is, again, if you're an active angel, you're an active VC, even more so, you know, you will typically look at, you know, 100 or more companies before you invest in one. So, because you just don't have the bandwidth to say, okay, like I've got 100 this week, they're all wonderful, let's look at, you know, all the marketing plans and the financial plans, and let's do due diligence on this. You just can't do it. You just can't do it.
You're looking for reasons to say no. Right.
And if you give that person an easy reason to say no, which is your cap table isn't prepared, when you're asking for money, you haven't got the cap table, you don't even know what a cap table is, forget it. Right. Like if you send emails with lots of bad spelling, forget it. Like life's too short, I haven't got the time. And like you go into the 99 bucket, you want to do all you can to be in the 1 bucket, which is not give the investor any reason to say no. And hopefully, as you go along, get them interested in saying yes. But like out of every 100, they've got to get rid of 99. And you know, you may have the best idea on the planet, but if you screw up, there's like 10 outside the door,
right?
And then there's 10 more the next day.
Right. How about presentation building?
Again, it's all part of the same bundle.
Okay, we'll just go on.
Although I think on that one, you know, you've got to be a little bit careful. I think it's on the one hand, you know, being good at presenting in a sort of formal way is a good thing. But you know, I personally think that particularly if you're doing that first presentation, right? Going back to my 100 to 1 thing, the purpose of the first presentation is not to get the investor to invest in your company. That is not the purpose of the presentation. The purpose of the presentation is not to do this dramatic, you know, all these charts and like all the how everything's going to be wonderful. Right. So you can have a quote unquote good presentation in that context. But the investor is not going to invest based on one meeting. The purpose of the first meeting is to get them to ask you for a second meeting, right, so that you've got down from the, you know, the first 100 to the next 25 or whatever it is that they have the second meeting with. And a lot of that is and a lot of investors probably reject this as a thesis, but I think it's true. A lot of that decision is an emotional one. And it comes to some of your points, right? Yeah. Like in that meeting, it's not you have the great slides. It is, by the way, that you understand what you're doing, but it's like if you don't communicate passion, right, which is sort of like a human value, I'm going to say we've got no passion for this. Like, yeah. Forget it.
Right. I've been to some, and I'm sure you've been to more of these accelerator final presentation day events, where the first chart or the second, third chart are these big pronouncements about, you know, there's 900 million people in the world, and this many are missing this major thing, and you know, there's cliche charts that have styles. I mean, when you're in that sort of a situation, I mean, how quickly do you tune out when you start to see the same style, you know, again and again?
In nanosecond?
Yeah.
I mean, I think it's a you know, it's a challenge for the accelerators, you know, in general, and I've been to like 2 in the last 2 weeks, 2 or 3 weeks to demo them. And part of hope I'm not going to step on any toes here, but like part of what the Accelerator program is doing for its customers, the entrepreneurs, is setting them up to present themselves to the world. But some of them, and one of the ones I'm thinking of in particular that I've been at recently, does it in such a sort of I don't know the right word is, but such a cookie cutter way that it basically devalues the whole thing, because like you can't tell them apart. And in fact, one of them, I was at an event after this demo day, and I went to one of the folks involved, and I said, look, whatever who I am, but I'm just telling you, those presentations, in this particular one, every single one of them, there's a point where you get to slide 5 or 6, and to your point, it just has a big number. And it's like 25 billion or 15 billion is like our accessible market. And you're thinking, like, enough already. It's like, everyone has got that. And the reality is your accessible market is some small slice of that, but it's not.
Otherwise,
so it's like, there's this sense that you have to make this big claim. And if you, every one of 10 presentations does that, they basically, the good ones are devalued by the bad ones, because they all just blur into this whatever.
Right. Well, I think one of the things you're going to find at the Foundry event, which is coming up, is the companies are so diverse that there's no way in the world the presentations are going to be the same. So I think that's one of the cool things about working with really early stage founders is they're not jaded and they're not trying to be cool or slick. They've got something that they're really excited about and they're trying to do it. So, it's been really fun to watch them and coach them a little bit. We're not worried about them having the most slick thing. So not to pre-sell it.
But they need the passion.
They do have the passion. We got one here in the room. She took her lunch break though. And then, breakthrough idea is sort of the other one that it comes up. I mean, obviously it's important to have a breakthrough idea, but if you can't execute on it, or if it's something that's so, out there. I mean, I'm just wondering about, valuing idea versus team versus other things. Where does idea or problem set, rank?
Well, you've got to have a three-legged, a three-legged stool, right? I mean, you can't sit on the stool unless it's got all the 3 legs.
Right.
And the 3 legs, at least for me, are going to be, is there a 25 billion? Well, is there a decent-sized market opportunity, right? Is there a real need for something which is of sufficient scale to mean that, again, looking at it as the investor, you have a chance of getting your money back with a decent multiple.
Sure.
And we should probably talk about what that is, because that, I think, is something that a lot of entrepreneurs don't really understand, like quite how the investor math works. So, the market and opportunity's got to be there, and it's got to be big enough. The solution to the problem that market opportunity is manifesting, has to be sort of credible.
Right. Should not require a miracle.
And then the third leg is obviously the team, and do they have the ability to execute that solution into that market? Unless you have all of those 3, you don't have something. So you could have the best idea into a wonderful market, but if the team's not structured right, they've not got the right, human characteristics, passion, blah, 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 it's not going to work. Or you could have a wonderful, kick-ass team. They've got this great solution, but the market they're addressing is really, really small. So they could be pretty successful, but from the investor's point of view, like that doesn't work. So like all of those 3 legs have got to be, as best you can judge, robust enough to support the stool, right?
Right. And then in terms of your return, I'll talk about that a little bit in terms of when you're placing money, how much you expect to get back and things like that.
So there's if you're talking about angels and VCs, the numbers are somewhat different. And roughly speaking, I don't know how you do it, but there's something like 250,000 active angels in the US. There's actually 7 million people who could be. as in by the current accredited investor standards, 7 million people roughly qualify, but there's roughly 250,000 active angel investors. And roughly speaking, you can sort of dump them into the minority, which are the sort of quote-unquote professional ones who make multiple investments and sort of understand term sheets themselves.
Right.
And then the majority who are making like 1 or 2 investments. And it's
Right.
just because like Cousin Joe came in and said, can you give me some money? And,
Right. Okay.
you know, whatever. So for the ones in that minority of the 250 who sort of vaguely understand what they're doing, if they more than vaguely understand what they're doing, they will realize that actually the math for them is not good. Right? So roughly speaking, the numbers work out like this. So I've invested in 10 companies. Statistically, the most likely outcome for me is as follows. If 5 of those companies, that's 5 actually, 5 of those companies will fail, so all of my money will go. 2 of those companies will just about live, and I will get some sort of liquidity from them because, you know, maybe at some point somebody buys the code or something. They're not really sort of viable ongoing businesses, but they don't die and there's some value at some point. So I sort of maybe get my money back on 2 of them. So that's 7, and there's 2 left, or 3 left rather, of which 2 will, again, on average, generate like 2 or 3 times. And you know what that, I think essentially what that math means is that for those 9, the 5 that go into the tank completely, if you account for like time value of money, the 4 that live basically net off against the 5 that died.
Right.
So for 9 of my 10, it's a wash, right? Even at like 0.5% interest rate, I've been better putting it in a deposit account. But I've made like 0.5% rather than washing out.
Right.
So essentially, all of my return comes from 1. Comes from 1. And here's this very scary statistics that angels are generally in total denial of, which is that the average holding period for any angel investor company in the US is how many years? 9 years. Good answer.
Yeah.
9 years. So most angels will say, no, I'm going to be better than that. It's going to be like 5 or 6 years because, you know, 10 years is a long time.
Yeah.
Particularly for like the older angel investor, that could be like a very long time.
Right.
So, you know, you've got to make all of your return essentially off 1 because the other 9 like net out. And if you're going to make a decent like compounded return over, let's call it 6 years, essentially what that means is that 1 winner has to be 30 times. Right? Has to be 30 times. And that's why any angel who thinks about it, if they've got like the head screwed on, is very sensitive to valuation, right? Because if you've got this great idea and like I invested in it at a pre-money of $6 million as opposed to $3 million, right? Like that's like one of, you know, if I do it 6, not 3, I've killed my chance to be an investor, and I've basically just become a philanthropist because I'm giving money away and I'm not, I'm losing money.
Right.
So again, the reason I bring that up at the risk of sort of boring you with all the numbers is that being an angel investor is a lot easier than being an entrepreneur, but like the math of it is not very favorable. Most angels lose money. Most angels actually lose all of their money. And the ones that understand how it works know how important it is to get in at a valuation that is sort of mutually acceptable. Right? So like entrepreneurs always think quite rightly that their companies are worth a big number. Right? And so angels are not negotiating it down because they're complete bastards.
Right.
It's because they know that unless they get in at valuations that make some sense, they might as well just like give it away.
I've heard some people say that if you're just getting into it, you're going in chance you're going to make 20. That sort of improves the odds. I know it's harder to work with
20 investment.
Yeah.
I think statistically, you know, if you're going to have the compound average return for angel investors is pretty good, like over time. The compound, you know, depending on different studies, is actually about 25%, you know, annual return. But it's incredibly dependent on a few very successful ones. And if you're not in those, you make 0.
Right.
And it's true of VC. So like, here's another fun fact. I I think in the last year, last couple of years, 95% of all VC returns came from 5% of their investment.
Right.
And what that means is, like, you know, your VC fund, you are in Facebook, and you're a genius.
Yes.
You aren't in Facebook, and you're a total loser, because like his return is whatever, yours is whatever. He was just lucky, right? But that's the way it works. It's so asymmetric. It's incredible, which is why all the Silicon Valley people talk about like billion-dollar companies, because they're the ones that make you, quote unquote, a successful VC as against a failure, because the returns are so asymmetric.
Right. Go ahead, please.
Yeah.
So I'm going to repeat the question. The question is, if a startup pitches that there is a near-term or relatively near-term liquidity event, either
Right.
you know, some sort of acquisition or partnership, is that more appealing to an angel investor than otherwise?
Yeah. I think there's like an entry-level question behind your question, like from the investor's point of view, which is, which they may or may not ask, but is essentially, so do you want to sell your company at some point? And if you say no, then like I just walk out of the door, because the only way I get my money back is if you sell the company. And it's totally legitimate for you to never want to sell the company, in which case that's fine, but you know, you're not going to get my money, you might get somebody else's money. So like there's an entry-level question about, do you actually want to sell it? And again, it's legitimate that you might not want to, but you've got to understand that you're not going to get money from many investors if that's the perspective. The sort of second question around sort of how do you position it in terms of objectives. I mean, actually, we could talk about that for quite a long time, because that's quite a sort of, there's actually quite a sort of sophisticated bunch of things in there. You know, and there's also a big difference between the angel perspective and the VC perspective in a number of respects, which we could get into. So I'll try and sort of summarize it. You know, what you described wouldn't necessarily be sort of super appealing to even the angel investor, because you could paint a plausible scenario that you exit blah 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 in 2 years. But again, the reality is it's always harder than you think. It always takes longer than you think. So the sort of, again, the slight red flag, if you just sort of pitching it to me the way you pitched it, would be, I might say, well, it's going to take longer than she thinks. So if at 2 years she's still struggling, is she going to give up and walk away? So you've got to be a little bit careful. But inherently, for the angel investor, what you described is, frankly, the more attractive option for most, again, rational angel investors. And the reason that's the sort of attractive for a rational angel, and when I say it, I mean not necessarily the idea that you're building it to flip it. Again, you're building a great company, and if it becomes attractive, that's great. But if you're comfortable with the idea that at some point in 5 or 6 years, you could sell it, you can see yourself selling it for like 40 million. From the angel investor's point of view, who understands the way it works, that actually sounds pretty cool. And the reason is this, that the vast majority of exits happen at around 20, 30, 40, 50 million dollars. The vast majority. So if you're willing to do that, from the angel's point of view, again, if they've got their head screwed on right, is actually quite a good signal. And there's an angel group that, I only learned this yesterday because I was listening to David Rose, who was one of the founders of New York Angel Speak. And he said literally that I think it's the Ohio, whatever they are, the Ohio blah, blah, blah angel group, they will literally say to you, they'll ask the question I asked a little bit differently. Not will you sell the company or not, but would you be okay if in a few years' time, the company got sold and you made $5 million. And if you say that's fine, they'll say you're the sort of person we want to talk to. If you say no, I want to go for 200 million, they'll say that's fine, you could do that, off you go, but you're not going to get our money because we know that we're much more likely to get you the 5 million and be along for the journey with you than to get the 200. And that apparently that angel group has the highest achieved return of any angel group in the country.
That's amazing.
Yeah, they're well over 25%.
So just building on that a little bit, if you come out of a corporation of some sort,
yeah,
where there's an industry expertise that you're a part of, and you find a segment that you know they're not going to go after for whatever reason because it's not big enough or it's not strategic for them today, but if it was bigger, it would be. And then you go and make your pitch and you say, by the way, I used to work for these guys and they need this, right? I think that would be even a hotter discussion.
Yeah.
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 Yep.
Yeah. Yeah. Well, there's if you're going down this, again, there's a lot of different things we're getting into here, but if you are thinking a bit more intentionally about constructing the company to sell it, not because you're building it to flip it, but because the end point is it's going to be sold. So why not actually internalize and think about that? Some people have described it. You as the founder, your board for that matter, if you've got a board, what you should start thinking about is not shareholder value, but acquirer value. Like, how do you build value in the company that makes it interesting to an acquirer? And that can involve, different decisions. So say, I don't know, say you've got some, new cereal bar or something, right? You could say, well, if we go to Whole Foods, we get really incredible volume, we can drive the business. But if we go to this smaller, regional grocery chains in regions where Whole Foods doesn't exist, then, and this is probably a bad example, so don't quote me on this, but we become potentially more interesting to an acquirer. So say, big food company X looks at us from above. They see that we've got this product, but they're already in Whole Foods already, right? But then in these other distribution channels. Right? So we've actually created, we have more value to them by not being in Whole Foods because they can stuff through Whole Foods as it is,
right,
but they can't get into these other places. So, we could have something that's not immediately in the sort of strict financial terms, revenue and profit maximizing, but we're effectively doing something that could reduce, it could have less revenue, but it could have more value to the acquirer. So you can have strategic decisions which you tilt a little bit differently if you're thinking acquirer value, not shareholder value. And you, the founder, all the shareholders have got to be on board with that idea. Otherwise, you're going to get into some fearsome arguments.
Excellent. Any questions over here? Back of the room?
And my question was, these companies that you invested in, what were the key characteristics that pushed you to make the decision to invest?
So I'll just repeat the question. So in terms of Adam's portfolio, what were the key characteristics that made you want to put your money with those companies? A blanket statement.
I don't think I can make a blanket statement. I would go back to my three-legged stool argument. And again, that's just me. Anybody can have as many legs or no legs, whatever they want.
Right.
But I would like to think that the things that I've invested in have got each of those three legs that I described, that they've got a solution to a market problem, which is big, with a team that sort of seems to make sense. I would say that of those three legs, personally, I may be right, maybe I probably put more weight on the team. For the simple reason that, the solution to the problem today, it might not work. right? The market might not be there. The problem might not be as compelling a problem, such that it's a nice to have, not a must have, and that as you get into the marketplace, you realize that there's interest but not enough demand, or the demand isn't there at the right price. So since that almost always happens, like there's almost always some sort of disjunction that happens between your original sort of hypothesis about, if I do this at this market, it will work, then you've got to change a little bit. And it's the people here that are crucial to whether that can happen, because the people here are the ones that have the insight that it's not working quickly enough.
Right. Well,
they can say, okay, we go from plan A to plan B. So the people becomes the most important of the three legs for me.
Sure, and especially if you're going in a market where there's another player who's already in there. They might be the first, but you might have a better
I think
team.
any market, right? I think anything, almost anything. And sometimes it works, sometimes it doesn't work out. Like one of the companies I invested in, the CEO was incredibly creative. Got Lyme disease, got worn out. So there was a sort of combination of CEO basically getting worn out and whatever by Lyme disease, and the business actually pivoting, and it's sort of okay because a new CEO is coming in who's not the founder. So I'm thinking I'm backing the right founder, but they get Lyme disease. My favorite one at the moment is I've got one company I'm invested in where, as of first of November tomorrow, right?
Yeah.
As of tomorrow, the CEO of the company is exiting the company to run for mayor of Nashville.
He's done.
So
Wow.
a replacement has been found, but
Right.
you can back the
Stuff
people,
happens, yeah.
but then stuff happens to the people. So it's like,
Exactly. Next question.
I have a question for you about companies found fairly
right, 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 yeah.
So the question is, how do you evaluate companies pre-revenue?
Yeah. And I mean, I would extend that to, like, frankly, any stage. I mean, I used to be, back in the day, I used to be a sell-side analyst looking at big public companies, and they're not easy to value either. So, it may be harder at the early stage, but it's difficult across the spectrum. But to your specific question, obviously the pre-revenue stage, it's the most difficult. And the cliche answer is to say it's an art and a science. So the science bit is that there are various things I can go on. So I could say, okay, I've seen, or I've looked at databases or whatever, and I know that companies sort of with the same sort of stage, with the same sort of team, doing sort of the same sort of thing, are basically raising money at 3 million. Doesn't mean that 3 million is the right answer for you, but then I've got like a comparable benchmark. Another thing I could do is say, like, if in the best of all possible worlds, I think this company can be like a $60 million company in 6 years' time, and I can do a financial thing and work that back and say, well, not necessarily that it's worth X, but again, if that's what I think is the best case outcome, then, like, for me to invest and get the return I need to get, I can't invest at more than 4. It doesn't tell me that it's worth 4, but like that's a different way of coming at it. So you can have the scientific bit where you look at some sort of outcome related calculation, some sort of present comparable valuation, and then the art bit, or the, I don't know, whatever you call it, bit is like, again, it's like the comparable thing. Like, people are paying $3 million for your stuff. Like, that's what it is. It might be, it might be 2 tomorrow, it might be 4 tomorrow, but if I want to invest and there's enough interest at that level, that's what the answer to the question is. So there is no good answer, unfortunately. And different investors will look at it in different ways. Some will be very focused. So like a VC would be much more focused on the numbers, very focused on the, I've done enough market analysis. I think they can get this stage. Maybe I'll discount that value back. Like, what does it make sense for me to come in at. This could just say, look, I think you're a great guy. You can be really successful. You've given me this convertible note of 3 million cap, whatever. Like, how much do you want? If you're lucky, right, you get that. So there's a whole spectrum of investor sort of sophistication. The more you get into the professional investor, the more they are going to look at the numbers, the more they are going to look at the comparables, the more they are going to look at your business plan and say, look, in year 3, maybe you can make 5 million of revenues, and if you can, like most companies in that space, are sort of selling at 10 times revenue. So like maybe in year 3, if you're 5 times 10, you could exit for 50, and then they do a calculation based on your financial model with their own, tweaking around it. So in science, there's no right answer. But to my point before, because there is no right answer, within reason, you should be prepared as the entrepreneur, I think, in your own interests, and actually to demonstrate that you're defending those interests and understand the value of those interests. You shouldn't be frightened of negotiating, and you've got to work out what your bottom line is. As in, like, I think this is worth $5 million. I'm not going to raise any money at less than 5. It's like totally your decision. You might never raise a dime, in which case, whatever. But you've got to have some sense of the value of the thing, which is difficult, sort of to your question. But I think again, in your own interest, you need to do that. An investor will not be put off unless you say, I'm only selling at 5, that's all it is. Right. And then they're going to say, like, guys, totally unreasonable. But if you say, in an opening discussion, I think around 5 is the right number, because like here are 3 companies like mine that just raised money at 5 million, and I'm serving a bigger market, or I've got a more developed team. So you tell me, Mr. Investor, why I'm not worth 5 million. It's like they now have to answer the question rather than you being the pain in the ass, like,
And what if they come in with, and here's how we spend the money in the first 6 months, right? So actually what to do with it.
Yeah, so obviously, you've got to be able to demonstrate what you're going to do with the money. That's like a fundamental, you say you're raising $500,000, I say what for, you say I've not worked it out, I'll get back to you, ding, you're out the door.
99. Yeah.
Or you could say like half of it's building a new website, half of it's hiring or whatever. It's got to be a little bit more than that. Not a lot more than that. Yeah. Yeah.
Exactly. And this is the last question, so,
yeah.
And it's pretty obvious, but the company value is different than the amount of money you're putting into the company, the investment.
Yes. Yeah.
Okay, so.
And it's like, it's one of the,
It's significantly different.
It's significantly different. And also, here's another sort of insider tip. To some extent, depending on the investor you're talking to, but for a lot of them, the amount of money that you're asking for directly feeds back into what they think the valuation should be, right? And this is more true with VCs than angels. But the point is, a VC or group of VCs investing in companies typically looking to basically come out with 20-25%. Okay, so if they want to come out with 20%, and you say you're raising $1 million, they're going to say, well, your pre-money is 4 million then. Because 4 plus 1 is 5, 1 is 20% of 5. If you say, I'm looking to raise $1 million, but my pre-money is 10 million, then like they sort of start not being able to compute that. It doesn't sound quite right. And by the way, it doesn't give them the sort of percentage that they want. But when you say, and I've done this a few times, when you say, I'm raising 1, then almost immediately any experienced investor is going to say, your pre-money is like 4 or 5 million. Like, I don't even know anything about it. You just told me you're raising $1 million, right? So so if you're too far off like where the expected ratios are, that can be a little bit of a problem. Like, and I'll sort of finish the thought.
Sure.
So say you want to raise $1 million, but you're telling me that the valuation of the company is only $1 million. So you think it's worth $1 million, I'm getting $1 million, the whole company is worth $2 million. That means I've got 50% of the company. On the one hand, you might be thinking, well, geez, I'm giving the company away, the investor's getting a steal, how can they say no? The investor actually in that scenario might be very worried. And they might just say, look, I'm not going to touch it. You say, well, how can the hell can that be? Like, I'm selling it on the cheap, you're getting 50% of the company, like, what's not to like? So the investor would look at it potentially like this and say, well, okay, the day after we do this, he and his founding team only own 50% of the company. A couple of financing rounds further on, you're going to own like 10% of the company because you're going to, if you continue to grow, you're going to get diluted down. And if you get diluted down really quickly, there's basically the high likelihood of an incentive problem. Because almost from the day that I give you the $1 million and own half the company, you're actually working for me now, right? And 2 rounds on, when you're down to 10%, you're working for the man or the men or the 6% of them that are women. You're working for them. And at some point you say, look, I can't be bothered to do this. I'm not going to make them rich. I'm going to get out and leave. So I don't want to take too much of the company because I'm just the investor, right? You're the one busting your gut. And I want you to keep busting your gut. So like, I want to own enough to get a share of the outcome that makes sense for me, but I don't want to have too much that you get disincented and just go off and do something else.
Well, this has been great. This has been so many good questions, guys. Thank you. So many good answers, and we need to have you come back. And hopefully you'll join us again. Thanks, Adam, and thanks for coming back. Appreciate it.